Hey everyone, welcome back to Corporate Decoder. Today we're diving into a document about the John Hancock CQS Asset-Backed Securities Fund, which sounds about as exciting as watching paint dry, or so you might think, but trust me, there are a few interesting twists in here, especially when it comes to who's managing the money and what they can change without asking you, the investor. It's like finding out your favorite ice cream shop, quietly swapped out your go-to flavor. So let's decode this thing. This document is a prospectus supplement, which basically means it's an update to the fund's main rulebook or prospectus. This supplement is dated April 10, 2025. It's designed to update some key aspects of the fund, like its investment strategies, fees, who's managing the money, and how you can buy shares. Think of it as a software update for your investment. Here's something important. The document states that the fund's investment goal is a fundamental policy. This means the fund can't just change its primary investment objective without getting approval from the shareholders, which are the people like you who invested in the fund. This is a big deal because it gives you a say in the fund's direction. To make any significant change, they need what they call a required shareholder vote, which means they need either 67% of the shares present at a meeting where more than half of the shares are represented, or more than 50% of all outstanding shares to vote in favour. It's like in fashion before tax them all outstanding shares to vote in favour. It's like needing a supermajority to pass a law. Now here's a crucial investment policy. This fund must, under normal circumstances, invest at least 80% of its assets in what they call ABS related investments. This means asset-backed securities related investments. If the fund uses things like derivatives, think of them as side bets. To get exposure to these ABS related investments, those will count toward that 80% requirement. So they are really committed to this type of investment. Here is what is interesting. Previously, the fund had wording in its documents that suggested the board could change the fund's investment objectives without asking shareholders. This supplement removes that old wording. Now shareholders get a say. This change ensures that big decisions about the fund's direction need your approval. Let's talk about fees. This part updates how sales charges work for different share classes. If you invest in Class A shares, you might have to pay a sales charge up to 255%. This charge doesn't go into your investment, but instead goes to the people selling you the shares. It's like a commission. Class U and Class I shares don't have sales charges directly from the fund, but your broker might charge you fees. So it's always good to check with your financial advisor about all the costs involved. The statement clarifies that these fees are additional and won't be deducted from your investment. Here's something about how you buy shares. The fund allows financial go-betweens, basically brokerage firms, to take your orders to buy or sell shares. The fund says it officially receives your order when these go-betweens get it. The price you pay will be the price calculated right after they receive your order, as long as it's in what they call good order. But what good order means can be different depending on which financial go-between you're using, so be aware. This clarifies how financial intermediaries can swap shares between different classes within the fund on behalf of their clients. This is called an intra-fund exchange. Let's say you are switching accounts or something. This can happen without a sales charge. However, it's up to your financial go-between to decide if this kind of switch is right for you based on their policies and your account type. The fund will do the exchange without double checking if it fits your particular situation, as long as you meet the requirements for the new share class. Let's talk about who is managing the fund. The fund is managed by an advisor and a sub-advisor. The sub-advisor handles the day-to-day investment decisions, but the main advisor oversees them. As of the end of 2024, the sub-advisor, CQS US LLC, had about $2.69 billion in assets under management. They are part of Manulife Financial. Also, Manulife CQS UK LLP had about $15.5 billion financial. Also, Manulife CQS Investment Management, which is a trading name for the sub-advisor, and another company called CQS UK LLP had about $15.5 billion financial. Also, Manulife CQS Investment Management, which is a trading name for the sub-advisor, and another company called CQS UK LLP, had about $15.5 billion in assets under management, which is a trading name for the sub-advisor. And another company called CQS UK LLP had about $15.5 billion financial, also Manulife CQS Investment Management. This section provides more details about the agreement between the advisor and the sub-advisor. The advisor pays the sub-advisor a fee for managing the fund's investments. This fee is an annual rate of 0.75% of the fund's managed assets, calculated daily and paid monthly. So for every $10,000 managed, the sub-advisor gets $75 per yayate or per year. I'd all type of for on dollars put us all together and give you my take. John Hancock CQS Asset-Backed Securities Fund seems to be making a positive move by giving shareholders more say in the fund's investment objectives. That's really important because it aligns the fund's actions more closely with what investors actually want. This can build trust, especially when markets get rocky. The fund's commitment to investing primarily in asset-backed securities suggests a focus on a specific area of the market. This could lead to some strong returns if that market segment does well. But it also means the fund's performance is pretty tied to that particular market, which could be a problem if that market goes south. Think of it like putting all your eggs in one basket. When it comes to fees, it's always important to keep an eye on those, sales charges and other fees from brokers. They can really eat into your returns over time. Being aware of these costs and talking to your financial advisor can help you make sure you're getting the best deal. The fund having a sub-advisor manage the investments isn't unusual. It's good to know who's making the day-to-day decisions and what their track record looks like. The numbers they provide about assets under management give you a sense of their size and experience. Overall, John Hancock CQS Asset-Backed Securities Fund seems to be aiming for a balance between specializing in asset-backed securities and giving investors a voice. Like any investment, there are risks and rewards to consider, but with a clear understanding of the fund's policies, fees and management, you can make a better choice about whether it fits into your investment strategy. Thanks for watching Corporate Decoder. If you found this breakdown helpful, please give us a like, drop a comment and subscribe for more plain English explanations of the corporate world. See you next time.